Good morning and welcome to Stock Market Today. It's Monday, June 10th, 2019. I'm your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for that free email to follow along with this show. Get daily stock ideas for you to consider. Hits your inbox every trading day before the market opens. So I hope that everybody had a great weekend. And let's dive right back into it. Fairly quiet trading on Friday after the jobs report, but U.S. equities were higher. S&P 500 posted its best weekly gain of the year after the index fell for 4 consecutive weeks. Oversold conditions and Fed rate cut expectations were the biggest drivers of the rally, in my opinion. That jobs number, 75,000 jobs on Friday, was a disappointment. There is no two ways about it. That started to get people thinking that the Fed is going to cut rates and may even cut rates more than once this year. Market now pricing in a 90% chance of a rate cut in July. Technology, consumer discretionary, and consumer services outperformed. That's comm services, rather. Utilities and financials were the only sectors lower on the day. Treasuries rallied across the curve. The dollar was weaker on the major crosses. Actually, dollar index posted its worst week of 2019 last week. Gold finished up 30 basis points. WTI settled up 2.7%. As we get to the desk this morning to kick off the new week, S&P futures are up 40 basis points. Asian equities were higher overnight. Hong Kong was a standout, up over 2%. European markets are mostly higher, though upside is limited. Treasuries are under pressure across the curve. Yields going higher. We're going to take a look at a good chart here today for yields. Dollar is strong on the major crosses. Gold is down over 1%. And WTI crude is up 20 basis points as we kick things off for the new week. So here's the index, S&P 500 large cap index. What I'm looking at here is I cleaned up the chart a little bit, a lot of support, a lot of resistance. We know the levels. Right now, the resistance level that matters, in my opinion, is 2,900. Why 2,900? Because it would break this series of lower lows and lower highs. It would break the near-term downtrend and increase the odds that we test the highs. We're also watching closely the RSI for a bullish shift. Now, off to a good start. Actually got above 50, but what we really want to see is a move through 60. We want to see pullbacks hold above 40 to indicate that we are shifting to bullish ranges. Not there yet, but the makings of it are there. Chaikin money flow is still neutral. So the indicators are still somewhat mixed, right? We had a strong 4-day rally. Easy to get excited. Futures are pointing to a higher open here today. But again, we want to watch our indicators, and we want to watch this 2,900 level. 2,900 is round number, right? Whether you believe in it or not, I don't. It's just another number. Investors will focus on the round number. But if we break above 2,900, we break the downtrend from the May 1st highs and start to think about new highs again. Support 2,720 to 2,800. No two ways about it. That's where it is. I mean, those are the key levels. Below 2,720, 2,650. Those are the key levels. Really what we have is a range-bound market over the past year. You can see it here. That really, from a trend perspective, doesn't get exciting until we're trading back at all-time highs. But let's just keep an eye on things. Market in a minute. 4-day rally takes the S&P 500 above key moving averages. We are now above the 50 and 200-day moving averages. Small caps continue to lag. It's almost becoming a running joke at this point. 10-year yield is nearing support. Look for a bounce. We are starting to see it here this morning. Oil holds above an important retracement level. We'll take a look at what that means. Futures point to a higher open here today. Let's look at the power bars. Power bars are getting back in gear here for the bulls. Dow up 96 basis points, 75 bulls to bears. S&P 500, 96 basis points to the good on Friday, 120 bulls, 72 bears. NASDAQ, massive outperformance on Friday. 25 bullish or very bullish stocks, 11 bearish or very bearish stocks, so back to greater than 2 to 1. Small caps still remain bearish. 389 bulls, 392 bears. There's your underperformance. Up 66 basis points, but still underperformed by 30 bips. Bonds had a big rally again, sending yields lower, giving some of that back here today. Technology, monster outperformer, 1.86% to the good, 23 bulls to 8 bears. Remember last Tuesday? We came in here and I showed you the chart of the XLK? So the tech looked overdone to the downside and was holding support. Monster 4-day rally from those levels. Follow the process. According to the Chicken Power Bar, small cap stocks have become somewhat more bearish than large cap stocks. Major markets are mixed. Stock of the day today, speaking of technology, CyberArk Software. This is the area of tech that we've liked. I actually wrote Mark Chaikin's Market Insights note over the weekend and highlighted software prominently in that note. CyberArk CYB closed at 129.11, down 80 basis points on Friday. Has a very bullish rating due to very strong earnings performance, very strong price volume activity, and very positive expert activity. The stock also has poor financial metrics, but 20 factors in the model, 5 in each of these 4 categories. Very bullish rating, strong trend, strong industry group, fishing in the right pond. Let's do our analysis. Very bullish stock, outperforming the market. This is relative strength, folks. You've heard me pound the table. Relative strength, relative strength, relative strength. Look for the relative strength in the marketplace. Remember when the market topped in October and cratered into the December lows? CyberArk was outperforming the entire way. And then look what happened as the market started to break out again. Monster outperformance. This is the importance of the process. This is the importance of relative strength. A lot of people say to me, yeah, but that sometimes relative strength doesn't necessarily mean it's going to go up. It could still go down. Going down less than the market is winning. CyberArk went down from October to December, but it went down much less than the market. If you owned it, you won. If you watched it and followed the process, you were in a position to catch this monster move. I like this pullback here to the rising long-term trend line, close to an oversold position, persistently bullish money flow. CyberArk looks compelling to me on the long side of the portfolio. Relative strength is that important. If you take nothing away from this show every day, it should be relative strength is that important. Sector tracker now, looking at the movement in the major sectors over the last 5 days. Materials, remember we said, let's start looking at materials. Top of the list. Tech, we hit on that one already. Staples, industrials, discretionary round out the top 5. Healthcare, energy, and fins are middle of the road. Utilities, real estate, and comms, bottom of the list. So a little bit of a shift here, huh? From a relative standpoint, we're starting to see some profit taking in the defensives, and investors are rotating into the cyclicals. We'll see if that lasts. Obviously, we want to keep an eye on it. That will carry bullish implications for the market, in my opinion. Let's watch. Let's keep an eye. Let's look for the trends that are likely to persist. I think materials are probably a little bit overdone here in the near term. I think that rates are probably overdone to the downside, and we're likely to see a backup in yields. So I wouldn't be surprised to see a pullback in utilities and real estate. Does that mean the trends are ending? Not necessarily. We want to watch and keep an eye. But I think near term, we could see some reversals. Industry-focused innovative tech services, which over the past 6 months has outperformed the S&P 500 by nearly 6%, 5.83%. However, its power bar ratio is weak. 22 bearish or very bearish stocks, 11 bullish or very bullish stocks. It's currently ranked number 15 of 21 subsectors, and it's moved down 4 slots over the past week. Some of the indicative names there: IQ, very bearish rating. Bilibili, B-I-L-I, very bearish rating. And NVIDIA, everybody's darling NVIDIA, very bearish rating in the model. Take your emotions out of the equation. Let's look at IQ, though, because I think there's a potential setup here for bearish investors if you want to take it. Very bearish stock, weak trend, but the industry group is strong. Media has been okay, but we take a weight of the evidence approach. So what do we have here? We have a very bearish stock underperforming the market. Now, it's not overbought or oversold, but money flow is bearish below a declining long-term trend line. To me, you definitely don't want to own this stock. And if you want to, if the option's set up, I'm not super high conviction here because we're not overbought. But if you want to look for high probability setups in the options market that might make sense to play the bearish side, I can't argue with that. Take a look at IQ on the bearish side. Yesterday's, or Friday's rather, gainers and losers. Not a ton of company-specific news. A lot of market-related movement. Illumina up 5.3%. Twitter up 3.5%. Full disclosure, I own Twitter. I use Twitter. I believe in owning some of the Peter Lynch approach. Own what you use every day. I'm on Twitter. So I own the stock. Vertex up 3.5%. Collaboration with CRISPR, getting investors excited. Foot Locker up 3.3%. And Monster had a shareholder meeting. Stock higher by 3.25%. On the loser side of the board, Arista Network analysts come away from their analyst day not feeling so great. CF down 3%, no real news there. Western Digital, no news, down 2.75%. Marathon, MPC, one of those energy names, down 2.3%, and LW down 2.25%. No real company-specific news driving trading there. Let's dive in. Nothing exciting about small caps. I know it's harsh, but those are the facts of life. Let's start with the basics. On May 1st, the S&P 500 took out its September high. Small caps never came close. Small caps remain below declining 50 and 200-day moving averages, right? So right away, we just know we don't want to own this. At the same time, momentum has steadily shifted to bearish ranges, while Chaikin money flow has put in a series of lower highs. This is the IWM, the iShares Russell 2000 ETF. It's just hard to get excited. There's nothing exciting going on here. When you're looking for your equity positioning within your portfolio, I think it makes sense to favor large cap stocks over small cap stocks in general. Will there be company specific outliers? Of course there will. But in general, if you're structuring, say, an ETF portfolio in your retirement account, if that's how you choose to do things, you probably want to favor the large cap ETFs over something like the small caps. That's what I'm talking about when I talk about strategic positioning. You want to favor large over small when you're thinking about your strategic positioning for your portfolio. 10-year yield, nearest key support. Remember we've been saying path of least resistance is lower, path of least resistance was lower. I was almost getting sick of saying it, but I didn't care because that was the trend. We've essentially gone parabolic to the downside, below the 50-day, below the 200-day moving average, and now we're going to put the 2% level in play. We're oversold here again, but notice RSI, momentum ranges. Notice how it's never been able to become, it hasn't been overbought since October, but routinely becomes oversold. That tells you that the strength of this downtrend is strong. It's fierce to the downside. However, oversold and nearing support, I wouldn't be surprised to see a backup in yields, as I said. So look for a pullback in your bond proxies in the equity market. But the trend here is lower. And what's amazing to me is that we're within 3% of all-time highs for the S&P 500, and investors are looking for rate cuts. So this is investors putting their money where their mouth is and betting on rate cuts. Oil holds a key retracement level. Oil made a strong rally from the December lows to the April highs. And we pulled back and we held the 61.8% retracement level of that advance. So we're now beginning to move higher. But what's interesting to me is energy couldn't muster much of a rally and has rolled over. Energy's bearish from a sector standpoint within Chaikin Analytics. So despite, I wouldn't be surprised to see oil work higher, but that doesn't necessarily mean we blindly go in and buy energy. We continue to do our work. Energy is still bearish. XLE has a bearish rating, and it is the lowest ranked sector from a power bar perspective. And gold is overbought in an uptrend as far as I'm concerned. Nice rally here. In our note last Monday when we looked at gold, we said the breaking of this uptrend, this downtrend line opened the door to 1350. We tagged 1350. Now we're overbought, and now we're watching the dollar. So the dollar continued to weaken. That's bullish for gold. But if the dollar rebounds from here, I wouldn't be surprised to see gold consolidate. So we're going to take a wait and see approach on gold right now. What's interesting to me, though, is a lot of the gold mining stocks continue to underperform and don't look that compelling based on our process. That's going to wrap it up for today. Head over to chaikinanalytics.com/survival-guide to sign up for my weekly action plan where I look at trends across markets and asset classes. I'll be back tomorrow, folks.